Good evening, everybody. Welcome to the session. I'm Ramesh Singh, joining you from New Delhi. So today's title, as you can see, it's on bond and its relationship with the US banking crisis. If you recall, my last session was on US banking crisis itself, where I discussed on the last Sunday about the reasons. What were the reasons US banking crisis did happen? Clear? अब in that session, government bonds had come in our reference. So, though I connected the US banking crisis with the bond prices and the bond yields, due to paucity of time, I could not relate to what exactly bond price is and bond yield is. So, few queries came to me to plan a session on bond yield, bond price, and their relationships to banks and the recently happened banking crisis in the USA. So this is part of that particular request from the viewers. So I welcome you all to the session, and in this session, as I told you, we will be trying to understand the relationship between bond yield, bond price, and the US banking crisis. Welcome, Nirvay. The problem is that, Nirvay, this session is exclusively in English medium. Though I can speak in Hindi, but this session has been planned for English only. Welcome, Avinash Pandey. In the meanwhile, while I discuss things, if you have got any query related to this session or any other session of past or any other thing about which you want certain clarity, you are free to ask. Okay? So, Nirvay, try to understand things. You will be able to understand. Don't worry. Okay? So, today's session is the relationship between bond yield, bond price, and banking crisis which occurred recently in United States of America. You cannot say the American banks are out of woods. It means that no new banks will face such a crisis. Still, nobody is sure. And I told you in my last week session how going into the asset and liabilities figures of banks operating in USA today, there are over 180 banks which are facing same crisis through which two banks went 2 weeks back, the Signature and Silicon Valley. Okay, so let's come to our discussion of today. In the first part, I would like to give you some idea to what are bonds actually. And when we use the term bond yield and bond price, what exactly they mean? Let's see them. Okay, it's very easy to understand. When you say bonds, bonds are basically are instruments, instruments through which, through which loans are raised. Clear? It means कि bonds are instruments which are used to raise loans. It means कि borrow loans. Now the problem is that कि who raises these loans? So these loans can be raised by governments as well as corporate houses. Corporate houses. In our country, corporate houses are nothing but public limited companies. Okay? So who can raise loans by issuing bonds? So governments as well as corporate houses. It means that there are primarily two types of bonds. One which are called as government bond and another which are called as corporate bonds. Corporate bonds are issued by corporate houses. Government bonds are issued by governments of a country. In case of India, bonds are issued by government of India also and states also. This is other thing कि bonds issued by state governments are vetted and authorized by the government of India. Similarly, bonds can be of short term or long term. अब in India, the long term bonds issued by government of India are known as G-SECs. That is, G stand for government and sex. And government of India issues short-term bond also. They are primarily treasury bills and cash management bill. It is a new one introduced by early 2010. But treasury bills are there the way they are being operated since 1986 itself. Okay. Up treasury bills and CNBs are issued for short-term purposes and G-SECs are issued for long-term purposes. Short-term means less than 1 year and long-term means minimum 1 year. But government of India has never issued any long-term bond which was of 10 year, 1 year, 2 year. It is of 5 year, 7 year, 10 year, 15 year. There are some perennial G-SECs also, which never mature. Clear? They keep changing hands of investors. Those who invest, they enjoy the benefit of interest. Those who sell, they lose the benefit of interest. Clear? So come back. Actually, bonds are instruments which are also commonly called as securities. Clear? Which are also called as debt papers. Okay? They are also called as debt securities. Clear? These are its various names. In case of United Kingdom, they are called as gilts in England. Gilt. Okay? In our country, long-term bonds issued by Government of India are called as GSECs and short-term treasury bills and cash management bill. States of India issue state development bonds, which are duly vetted by Government of India and authorized by Reserve Bank of India. So in one line, concluding the thing, bonds are debt papers issued by either governments or corporate houses. Clear? The next thing is what are actually bond yield and bond price? Simply put, yield is the interest which you enjoy, and price is the price at which bond is sold. Bond is sold. Up see the trick. The trick is that suppose a bond is carrying interest rate of 5%. Clear? 5%. It means a bond of Rs 100 will have sale price of 95 rupees only. Added 5 rupees, it will be of 100 rupees. Clear? It means कि a bond of 100 rupees, a buyer will purchase in 95. Clear? It means कि the time you purchase, bond issuing company or government is getting only 95, while you are getting a paper of 100. If you want to sell this bond right now, so you will get 100 rupees. So you enjoyed the benefit of 5 rupees, which is interest. Is it clear? Suppose in future, interest rate is 5%. Suppose Central Bank of India RBI increases interest by 1%. So this interest rate will ultimately head to become 6%. Bond price which was 95, it will fall down to 94. Clear? It means कि yield goes up, bond price comes down. Yield comes down, bond prices go up. I hope you got the point. Derivative is a different thing. Nirbhay, derivatives are traded in future market of a stock exchange. Clear? They belong to security market where bonds are also traded. Okay? Derivatives are not an instrument to raise money and raise loan. They are avenues to invest money. But bonds are avenues where you can invest also and through which you can raise loans also. So derivative is a totally different thing. Derivative can be made out of currencies also. They can be made out of interest rates also. They can be made out of commodities also. And in commodity, it can be agricultural commodities, it can be non-agricultural commodities. For example, metals, zinc, copper, aluminum, gold, all are traded in commodity markets along with agricultural goods also. Clear? So here we are concerned with bond and its relationship with US banking crisis. Clear? So now try to understand. Ki bond yield is nothing but interest which bond buyer gets on the bond. And bond price is the price at which a bond is selling. When bond prices go up, it means interest must have come down. And when bond prices go down, it means interest must have gone up. Clear? Is it clear to you? What happened actually? Just see how connected to banks. Why banks invest in bond? The problem is this. Actually, as you know, banks have to earn money, earn income on the deposits they mobilize. All money which they mobilize as deposit, they don't offer as loan. Central banks and regulators of banking industry, they don't allow such thing. So a part of money they maintain as liquid asset. The bank maintain their deposits in liquid assets. Okay. And what are liquid assets? Liquid assets are those assets which can be sold off and converted into money quickly and easily. And best liquid assets are actually government bonds, and then comes basically corporate bonds. Clear? Corporate bonds. अब suppose कि a bank is maintaining 15% of its total deposit in them and bond prices fall down. So what does it mean? A bond was invested with 95 and its price has fallen down to 94. Now, at such a point of time, if banks want money, banks want, a bank wants money. Let me rewrite. So suppose a bank has invested in bonds at 95 rupees. Central bank has increased interest rate. The interest rate has gone up by 1%. So the bond price has fallen down by 1 rupee. Now a bank wants money for any purpose. So they will have to sell this bond at a loss of RS1. This will incur loss to bank. This is what happened in case of Silicon Valley Bank. Due to certain rumors, certain news items appearing in media, depositors of Silicon Valley Bank ran to withdraw their deposit. And as much money was not lying in the bank. So the Silicon Valley Bank started selling government bonds and corporate bonds in which they had invested their money at lower prices, booking loss. And in this process, the whole bank was gone with the wind. Clear? This was the crisis because due to Great Recession right since 2008-9 onwards, due to economic disruptions caused by COVID-19 pandemic in America and Europe, governments of the country had been pumping too much money in the economic system to support demand and enhance their growth rate of economy. And what was being done by that time? Interest rate was being cut by American Central Bank, Federal Reserve Board continuously. You can imagine the trillions of dollars were pumped in economy at very low interest rate. In some developed countries, interest rate fallen down to negative. Imagine. So that people buy more goods and services. People spend money to revive economic system. Okay, it was good. But once inflation fared up in America, crossed 9.5% per annum, first time in last 40 years, Central Bank of America ran to check and control inflation. And what central banks can do to check inflation from rising? They will have to increase interest rate. Okay? Until March, Central Bank of USA has increased interest by around 5.5%. Imagine, suppose you purchase a bond in 95 when interest rate was 5%. When this interest rate has increased to 10.5%, imagine the impact on its price. It will be of the value 89 rupees 50 paise only. See the loss. When banks fetched a loss of 5.5% because they invested when bond prices were 95, when they were selling these bonds to get money because they have to pay back the depositors in their bank, they sold it at 89 rupees 50 paise, a huge loss. This is a loss of rupees 550 in terms of our currency. This loss was so huge, a Silicon Valley Bank and Signature Bank could not sustain. They completely closed down within one day. Just imagine. This is how bond yield, bond price are connected to recently occurred banking crisis of USA. Clear? Coming to India, a case of Indian banks. Case of Indian bank is quite different. Our banks, if you compare their assets and value of their liabilities, our banks are much safe. Their assets are of higher value and liabilities are of lower values. But that was not the case with either Silicon Valley Bank or Signature Bank. In their cases, the difference between the values of asset and liabilities were too close. Okay? So till depositors did not come to withdraw money from their accounts in large number, they were able to sustain and operate smoothly. But once there was a rush of depositors because they had a fear that this bank's balance sheet is not healthy. This is balance sheet where you have the idea of assets of a bank and liabilities of a bank. So once depositors of Silicon Valley Bank as Signature Bank had some idea that asset liability of my bank is not healthy. So in large numbers, people started visiting their bank branches, withdrawing money from their bank accounts. And you know, in bank, a particular amount of money is only safe because you get insurance cover on them. In case of India, it is 5 lakh rupees in case of one bank account. Suppose in a bank account you are having 10 lakh rupees, so you will run to withdraw rest of the 5 lakh rupees and bank is facing a scarcity of cash. They are unable to pay back money to their depositors. But depositors, you can't do anything. They are decreasing demand of withdrawal. In this case, the liquid assets in which banks had invested, they started selling them. They had to sell in loss. And to this loss, soon banks gone with the wind. This is banking crisis. This is direct connection of bond to the banking crisis of USA. Our banks are having a bit higher non-performing assets, but our banks are maintaining higher capital adequacy ratio also. Even then, asset liabilities values are not as bad as these two banks which collapsed 2 weeks back. Clear? This is all about bond prices, bond yield, and banking crisis of USA. If you have to ask something, then you can keep asking. Meanwhile, see the other slide. What about other investors in bank? Because other investors can be individual citizens, individual citizens. They can be investors, companies, investors. For example, mutual fund companies. In case of India, it can be LIC also or any other entity. Whosoever has invested in bonds, they will same similar risk. Suppose LIC has invested in government bond when its price was 95. Now its price is 91 due to increase in interest rate because you have seen how RBI has increased interest in last 6 to 7 months. It has increased interest rate by around 2.5% point. Clear? And just within few days, new monetary policy is to be announced and experts are guessing a minimum 0.25% interest rate might be increased by RBI. That is the repo rate of India. In case of America, that is known as Fed rate. So suppose LIC has put its money in government bond of India. They have invested 95 rupees for 100 rupees bond few years back. and 4% interest rate has gone up. It means ki its real value today is 91. If LIC wants money for some reason, so they will have to sell this bond at 91 rupees, taking reference of America. Okay? So they will book a loss of 4 rupees each bond. It might be quite detrimental for LIC. Clear? It means ki whosoever is bond buyer, bond prices and bond yields have similar impacts on all of them, be it a bank, be it a mutual company, be it an insurance company, be it a portfolio financial investor, whosoever. Clear? How they impact the private sector investment? They impact actually. What happens is suppose RBI in India has increased repo rate. It has been increased. So money becomes costlier. So investment goes down. Those who have invested in government bonds, they book loss. But on the other hand, new investors don't invest much because loans have become costlier. Clear? It means key bonds yield and price are dual-edged sword. At one hand, those who are invested in bonds due to interest rate hikes, they book loss. On the other hand, new investors are not able to invest as much they wish to invest because the loans have become costlier. I hope it is clear to you because bonds impact through their prices, and their yields. Clear? So anybody wishing to ask anything is free to ask his and her question and doubt. So this is the relationship between government bond or corporate bond, their prices and their yield. Such things have been asked in PT on few occasions. And since throughout 2022, bonds have been in news. They became recently hot news when two banks collapsed in USA. So you can expect questions in upcoming prelims 2022 on bond, its price, its yield too. Clear? I have reserved a page with the title miscellaneous. You can ask some question. So few hits for exam. About bond, you need to know who issues, the government as well as private or corporate houses. Corporate houses can be public sector also. Bonds can be of short term and long term tenure. Clear? What are bonds prices and what are bonds yields? Clear? Yield. Prices at which bonds are sold, at which they are sold, they are sold, and yield is nothing but the interest rate which bond issuer is paying. Clear? The relationship is when bond prices, when interest rate goes up, the bond prices come down. This is case 1. When interest rate falls down, case 2, the bond prices go up. Investors book profit if they sell. Investors book loss if they sell the bonds. Clear? And how bonds are connected to banks. How bonds are connected to any investor. any investor. These are the topical points of today's discussion. Clear? This is all about today's session. My next section is going to be on current affairs. When you prepare for civil services exam, or for that matter any exam in India, the experts and mentors advise you to revise current affairs. Now the question is, when you say current affairs, what do you mean? How much current affairs should be? In the term current affairs, what current stand for? Is it stand for few months, 1 year, more than 1 year? How many years? How to know that? Because such questions are usually asked to me by the IAS aspirants. So in the next session, going to take place on coming Sunday 8 p.m., we will be discussing and analyzing how much current affairs should be. Clear? In the meanwhile, this is detail of the course which is starting at my center in New Delhi, which is available in online mode too. You are welcome to join it. You can join my official Telegram group and official Telegram channel to ask me any question. These are my websites details where you can visit to know about the upcoming courses. Thank you very much. See you.